So this is going to be fantastic. We got Derek, Alexandrenko, and Chris Ventre in the house. And of course, my co-host, the man, the myth, legend, Annie McMullen, here to talk about built to rent on a variety of different levels. We're going to talk about the asset class, our team, how we work with other people, the phases of development. We're going to try and give a nuts and bolts workshop on the asset class itself and everything that we love about it and how we partner with other people. So let's go ahead and get started with this. I'm going to do really brief intro because we got a lot of covering of topics to do today. So we got Derek, who's built many hundreds of homes. We're working on 3 different subdivisions right now. So we're going to talk about built to rent in general. We got Chris Ventre on here. I'm going to introduce him as well. He is our acquisition specialist, also partners with Derek on Hammerhead Capital. And he has been acquiring land for institutions for quite a number of years. And then Andy, who's also done develops in California. All of us got together probably about 3 years ago and then started working on this most recent, or I should say the very first subdivision. Andy, is there anything that I'm missing that you want to add? Be our color analyst for the day.
No, I just think that, people really need to appreciate the experience of this team that we put together. I mean, Chris Vaughn's been working for some of the largest and strongest institutions in the country, and we'll get into a little bit more granular. He likes to kind of, defer to some of the larger topics, and I understand it, but I'm hoping today that people are able to take away and appreciate the kind of nuanced process of getting something actually approved before we even get to the point where we're kind of bragging about what we've done.
Yeah, it's a little bit hard to find information on build to rent. If you go on Amazon, I've been on there looking for build to rent books. There's nothing on there. I believe Derek is interested, if not has already started putting together his first build to rent book at Legacy. One of our partners, Keisha of Kohler, is getting ready to do an ebook, or actually in the final phases of editing his ebook. And Andy suggested that we do some webinar content and some videos on every aspect of it so that we can provide more and more information about it. But why don't we go ahead and get started with just in general, the asset class. Andy, what do you think the audience needs to know? Direct your questions to Derek and Chris, but what do you think that they should answer about the asset class in general? What kind of question would you like to ask them?
Well, yeah, no, I think we should start from the very beginning, because there's a lot of people on this call that do have some experience in development and built to rent, and they've kind of probably followed us throughout some of the process of us developing. But let's just talk, big picture. Chris Vaughn's, let's start with you. What would you like people to kind of understand about just the development process from the beginning? So let's just talk from acquisition to kind of getting things pushed through the city, because when people think about development, they think of this kind of, wow, he must be having meetings upon meetings with city officials, and there's part of that. But then with the engineers, you got to change. And then you're also a landscape architect, so you got to put those pieces together. So let's just kind of give people a sense of what you do on the acquisition side before we even get into kind of what is built to rent and why do we love it so much.
Certainly. Yeah. Thank you for the introductions, guys. On the acquisition side, first and foremost, we like to go into markets that we like. Initially, with this group, we have targeted tertiary markets that show strong housing growth and population growth. We like to focus in on those MSAs into growth corridors and growth areas and look for parcels of land that are not encumbered and, produce typically, good speed to market. We'll go in and look at the shape of the site, the size, obviously, physical characteristics from ingress and egress to utility access to topography. Do we have good drainage outlets for the site? The soils of the site, is it in the flood zone? Do we have wetlands issues? And so we'll go and look at all the physical characteristics of these particular properties, and then look at rapid sort of prototyping or concept planning on the site to make sure we can hit the densities we want on the site as well. So that's a real sort of rapid fire.
So some of these words that you use, right? Topography. So people kind of look at, what the prototype on how we kind of actually pull all these pieces together. So in that process of you kind of pulling all these pieces together, over time, you kind of created probably these checklists. Many of them are in your head. But when you kind of actually begin, what are you using as your tools to kind of vet a market I mean, we've already done some of the kind of front end work on here's the markets that we really like. Here's the land that's inexpensive enough for us to build on. Here's the growth that's in and around the area. But when you got to get a little bit closer, you've actually got to go start meeting with the city. You got to start meeting with the engineers. You got to, I mean, there's a lot of pieces together. So just like high level, start from kind of some of the steps that you would take and what tools you would use in order for starting a development project.
High level, I'll back up a little bit and hit back on the land acquisition part. The tools I use, I do a lot of GIS analysis, geographic information systems. So I pull a lot of public federal data as well as local data to, analyze markets and sites as well. Moving in, once we target a site and we want to start moving forward, we'll start talking to landowners and typically either get it under contract or under option. At that point, we'll have a due diligence or inspection period on the property. And that's when the real work starts. We'll have ourselves under a time frame where we have to get the property entitled before we're ready to close on it. If we can't get it entitled, we don't want to take the risk on putting money on the property. Entitlements will vary from municipality to county and region to region. The entitlement process, for those of you who aren't familiar with it, is taking a piece of land and getting it approved for the particular use you want. In our case is build to rent, which is loosely defined product in and of itself and is particularly not defined at all in most jurisdictions' zoning codes. The challenges we face in the entitlement process, there are many. So we have, a lot of council members or planning commissions or mayors that don't understand what build to rent is. And so there's a large educational component and lobbying component as you move through the entitlement process. Everything from I've had to meet council members in their front porch with printouts because they can't get emails, or people thinking we're doing products that we're not. Some people think we're doing Section 8 housing, but we have to educate them on this is a market rate product. And so there's a lot of political navigation you have to do, at least as far as what we've encountered. And that's typical of any development that's not what people are used to seeing. And that's human nature. It's something new. They might have some red flags thrown up on their side just because they don't understand it. And that's a perfect opportunity to develop a great relationship with the city. If it's a municipality you want to do more than one project in, coming in there and kind of being upfront with what you're doing, walking them through the process of what this product is and how it benefits their community.
Cool. We'll get into the working with the city a little bit further here in a minute. But I wanted to mention, being that we are posting quite a bit of content around build to rent, we're getting a lot of people reaching out to us from Portland, from Phoenix, from Kansas City, from other places, including even places on the Upper East Coast. And people are like, hey, would you be interested in purchasing this land? Would you be interested in partnering with us at this capacity in this particular market? And the reality is that Derek and Chris are both in the city of Lafayette. This is where they grew up. This is the territory and land that they know best. And right now, for the most part, we are staying within a 4-hour radius of Lafayette, which stretches into parts of Texas, including Houston, Dallas, and Austin. But primarily, we're working right now in Alabama and Lafayette, including 2 projects that we have going on there at 221 and a 98 unit. Build to rent is a very different business model depending on what market you're in. And it's not the same in Phoenix as it is in Atlanta, as it is in Florida, as it is in where we're currently doing. We really love that land is incredibly cheap, that there is very little bureaucracy against us, and there is a pro-growth, favorable government with people moving into the area for our specific type of product that we're building. Anything else that you want to cover in terms of market or the differences between doing it here in, I should say, in Lafayette versus in other parts of the country, Andy or Derek?
Yeah. Well, actually, I also wanted to kind of tie it into your audience because I think, most of this audience is of capital raisers and JV partners. And I think when you hear somebody like Chris and Derek talk about what they do, you can kind of assume that they have absolutely no time to raise capital, right? I mean, they have to live and immerse themselves in what they're trying to get approved and what they're trying to get done. So for people on this call that are interested, or our listeners that are interested in raising, you can understand your value, right? And putting pieces like this together. We'll get maybe a little bit more granular about the process of how we raise capital for these deals. But I think Chris hit it, is the education part, right? Understanding what it is that we're trying to achieve. And Chris, I like him to go a little bit granular, but I understand that I've kind of reached that phase where we've hit certain levels of understanding. He's very good about just kind of giving the broad view. And I think that most people, when they hear about build to rent, they think about development. And
Yes.
development has its own connotation, which is, oh, you're building stuff now to sell. That's pretty crazy, right? You're going to try and get all of the mayor, city council members, planning commission, neighborhood council to understand that you're going to build something. Then you actually have to go through all the engineering, all the soil testing. And then you mean to tell me at that point, you're going to start and build all the streets, the roads, utilities, and tie-ins and all that. And then after you've gone through all of the vertical construction, now you got to market to a community all these different units to sell. That sounds like a mere possibility, which is part of the reason that you've got a lot of people that are looking at development saying that's crazy, right? Even today, right? Even today, as market rates go up, a lot of builders have kind of slowed down on the build to sell. But what people have to understand about build to rent is that there isn't supply. And in certain markets like Lafayette and Broussard and Foley, we've got all of this growth and new factories coming in, new distribution centers coming in, et cetera, but there's nowhere to put these residents in these communities. So that's kind of what I want people on a high level to think about. Chris and Derek are incredible at kind of getting us through that process. Ruben and I are kind of taking credit from the tip of the iceberg, right? After all of that work has been done, now we really got to get to work and forge the right relationships, manage the asset, make sure we got the right property managers and vendors in place. So that's kind of what I wanted to hit for why capital raisers are so important in getting these projects to the finish line.
That's a really, really important differentiator, because a lot of people, when they think, just like you mentioned, of building houses, they think of slowdown, and the opposite effect is happening in the build to rent industry. The demand for subdivisions from institutions and people that want to buy these bulk amounts of houses is very high. And we can only, as builders, provide them with 2% of what's actually in demand for. When we put together a subdivision, we stabilize it, we rent it out. There's incredible demand to purchase this because it's like multifamily. It's run as one commercial asset, and it's based off of the net operating income of the entire subdivision. We don't sell it like individual houses. We sell the entire group of houses at one time. So that's a great differentiator. Let's talk a little bit about the construction and give Derek the opportunity to talk about his background and what kind of product he's building and what he plans to do in the different markets that we're tackling now and into the future. Tell us about your history building, how you got into it, and then let's talk about the actual product that we're building, my friend.
Sure. Yeah, I started like, most contractors, with smaller projects, remodels 20 years ago. Eventually realized it's easier just to build new construction and get exactly what I want. I've done that for about 10 years, mainly for my own portfolio, just building units and renting them out and holding on to them. And like they said, we met a few years back, decided to scale this up. It was good timing for Chris and I. We went to high school together, so we've always wanted to do something, but we're always doing our own thing. And then I met Andy. We decided to scale this up, and it really coincides with what's been happening in the market. Through those years of developing my own rentals, I've gotten a lot of feedback as I build one floor plan, go to a different floor plan. I also handled leasing those over the years, and we get firsthand feedback saying, oh, I really love this, or, I wish this was a little bit bigger. I can't quite fit my furniture here. Probably built the same basic house, but with small minor changes 20, 30 different times. So now we have a cookie cutter floor plan that really works well for most people. And there's not a lot of waste. We're able to get 3 bedrooms in a 1,200 square foot footprint, which is very good for what happened the last few years with cost. We get a pretty good rent, per square foot in relation to that vertical construction costs. And a lot of times we use very resilient materials, either LVP plank or stained concrete floors. We're located in the South, so we don't have to mess with basements and things of that nature. So our cost of construction is relatively low in comparison to other areas.
One of the main things that you pointed out is the size of the houses that we're building. If you listen to Derek closely, He said 1,200 square feet. When you think about a cottage or house this size, it reminds you of a 2 or 3 bedroom apartment. We exactly build them for that reason because they're very similar to apartments, except they have that home feel, right? So the renters typically, when they have a doggy door and a side yard on both sides and then a backyard, very nice appliances, brand new everything, stained concrete flooring, wood touches, luxury faucets, and ground molding, and everything looks beautiful. Would you consider this more of an A-class type of building, even though it's set to be the size of an apartment, essentially?
Yeah, I think they're A class. They're not luxury, but they're right underneath that, so we still have nice finishes with granite and undermount sinks and stainless stuff, but nothing over the top. We can still get these things in bulk and keep our costs down, but they're definitely higher end compared to just a normal apartment.
So what
we
kind of,
capture, those young families, either engineers that are just graduating from grad school or college, or, people that are tired of being in an apartment, having to go up a couple of flights of stairs, or they're about to have their first baby. So those are generally the type of tenants that we get.
so there's 4 million or more homes needed to supply the demand across the country. What about specifically in Lafayette? Is there a lot of demand for renters where we're building?
Yeah, I mean, the units we have, we were lucky enough in that project, we were a little ahead of the game. We had some units that I had previously built. So we had tested it before we ever even started on more units, and those are all leased up. So, and above our pro forma. So when the market was really hot and single family homes were selling like hotcakes and over asking price, people couldn't afford to buy. And then now with the rates, no one's trying to buy. So we kind of win either way. So it's worked out.
Yeah, I call this kind of, Ruben, the golden triangle of what built to rent has been. And you got the supply constraint, which you mentioned, right? And I think since 2008, it started to become a little bit more regional. 2008 hit, everything stopped, right? The music stopped for everybody. You couldn't get a loan anywhere. Now I think you got ascending market, descending market. So you got one edge of that triangle is that supply. Then you've got kind of rent that's still growing. We try to underwrite it flat, but it is still growing in these communities that need housing. And then you've got this other piece that we could have never predicted, which is the affordability gap. The amount of rent now compared to what people were paying for mortgages across the country is almost $1,000 delta. That's a big number. And then I think the other thing that you would consider in built to rent and why it's probably made a little more sense, maybe some luck, I don't know, but we built for the young families, but we notice is that a lot of the elderly, maybe it's even empty nesters, they love the idea, they're living longer. They love the idea of being in this new property with the backyard and barbecue, and the only thing they have to do is turn their light bulb, right? So those are kind of all these factors. Plus, compared to multifamily, the expenses are just so much lower, which in today's market is a big deal, right? If you're underwriting a project where you got 50% expenses across the board on a multifamily project, and you got 29 to 32% because you got mostly new stuff, there's a huge delta there in valuation.
So how would you consider, Andy, this different as an asset class than multifamily in terms of raising capital, in terms of what people are looking for, in terms of return on investment? Is it a similar profile? Is it riskier to do development? At what point does somebody capital come into the project? Is it at the land phase? Is it at the infrastructure stage? Is it at the vertical build out of the actual houses going vertical?
I think this kind of comes back to the education piece, because when people think about development, they kind of consider it as the whole, right? Which is, there's risk in supply costs and there's risk in actually building things. But the real risk, the most risk that you will have if there was just some kind of curve, the largest risk would be in what Chris is doing, is stripping away the entitlement risk, right? You've got approval from the mayor, you got approval from the city council. Now you kind of move into this next stage of risk, which there still is, which is, are you going to get your environmental and engineering done? Which is in cases that we've already been able to, that's really more of a formality. So that's maybe another 6 months, right? Where you're kind of waiting before you can actually put the streets and roads and utilities in. And at that stage, there's some risk, right? Because one, you don't know what supply is going to look like. You don't know what the market is going to look like. You don't know what the lending market for horizontal and infrastructure lending is going to look like at the time that you get to that point, right? And then you've got, I think, much less risk by the time that you get to where Derek is on our Crest project, which is building out these units all in the same kind of way. So to answer your question, the difference is, yes, there's a risk reward certainly for multifamily as opposed to built to rent. But I would argue in this market today, the people that were expecting their cash flow from multifamily projects, maybe to get their cash flow in 6 to 9 to 12 months, I'd be very careful if I'm an investor looking at multifamily deals with 50% operating expenses, the interest rates where they are, the cap rates, which could be climbing up. I'd be very, very leery about looking at those types of deals and thinking I'm going to get my cash flow in 18 months. In that way, built to rent is kind of caught up a little bit to multifamily. I try to tell our investors that they shouldn't expect any return. We'll give them valuation, but we're not going to give them, any cash flow. So those are some of the differences, Ruben. I mean, there's a number of others, but I think you also got to consider the new stuff versus the old stuff. There's a lot of risk that's kind of stripped out by having new stuff that works.
In general, would you say that this build to rent subdivision development for a lot of builders and developers is more profitable, less profitable, or equally profitable in comparison to multifamily value add?
You mean for the investor?
For the investor
the
and for
investor,
the
yeah.
GP, for all people that are involved.
Yeah, absolutely. I mean, when you think about, when I kind of mentioned those stages, right? At every stage, there's an opportunity to be increasing your valuation, right? So if you came in early at the stage we are, for instance, on Broussard, we have what's called a safe agreement. I can go into that a little bit later. But basically what it means is it's a simple agreement, future equity, somebody that wants to get in early and kind of go through the process of engineering and environmental. They're put their 100 grand in, let's just say now, in 6 to 9 to 12 months, they would have a bump in their equity. So their new basis, by the time that we start the infrastructure, is now, let's just say, what's a 15% increase in value. And that could be determined by what we decide to pay out to that investor or what the market bears. Now that new valuation is at, let's say, 15 to 20%, that would be their new starting point, right? So their equity multiple is based on that. Their IRR is based on that. So you can imagine the kind of increase in equity that person could produce. Now, we kind of look at it from the risk perspective, which is, what is the yield on cost? What would be the total amount of stabilized NOI that we can create against all the costs that we put into the project? So by the time that Derek is finished with building out these units and our leasing team's got everybody in, what's that stabilized rent versus the expenses against what all of the costs that Chris ran up on all the other stuff that he's got to pay for and all the stuff that we've got to pay for? What's that yield? And that yield is so important because, as I was mentioning earlier, when cap rates start to come up, interest rates start to come up, you've got to have that spread for the property to be profitable. And that's part of the reason that development is so much more lucrative if you can keep those risk mitigants at bay. Where we try to come out to the market with pretty similar, decks, I would imagine that most of the multifamily internal underwriting that we would have would be far higher in a development than it would a multifamily project.
Yeah, for investors that want to get involved with passive investing at some level or investing in private placements into commercial real estate syndications, you got to realize that in the multifamily space, there's different sub niches, right? There's A class, B class, C class, and complete gutting jobs, or D class, where you have different things and goals that you're trying to accomplish. A lot of times to the A class, you may get a lot more cash flow up front and a lot less back end equity. And with B and C, you get a little bit more back end equity and less cash flow. And D, you get no cash flow, very similar to building a development where you get the big amount of money is in the back end equity. So that's an interesting thing to point out, but it's not for everybody, right? Because people have different goals and some people need their cash flow and that's what they want. And other people are trying to create wealth for different reasons, whether that's back-end equity or long-term generational legacy wealth. Anyways, let's talk a little bit about the underwriting and loans. I don't know if you want to take this, Andy, or if you want to direct some questions in regards to, because a lot of people are asking and curious about, how do you underwrite this? How does this compare to the underwriting for a multifamily?
Yeah, and I think that probably most of the people listening have seen changes in the multifamily, but Derek and Chris and I experienced quite a shock when we signed our loan documents for Crest. I mean, we had obviously loans for the land, then we start a loan for the entire project, right? And so that includes a debt fund that we get, and we've got certain draws, right? So Derek's got to get to certain milestones. But the market changed over the course of us trying to complete this loan pretty drastically. Now, if we were to look back, we feel pretty fortunate that we got the rate that we got and we got the loan to cost that we got. But we had signed the documents, and the next day the lender said, "Hey, well, excuse me, guys, I'm going to need about $800,000 more in equity for us to get to that loan to cost that we want." So it's changed in that sense. What I would say is that I think equity, and it's a good thing for people to think that, equity's on the sidelines. It's a good thing that there's equity on the sidelines, because for old guys like me and Irish Kevin here, we remember that there was no equity on the sidelines. There was no cash. There was nothing in 2008, and even some markets in 2002, that cycle. But there is people that really love, one, the yield of built to rent, right? Because they can go to their pension funds, CalPERS, CalSTRS, et cetera, and they've got a yield. They've got potential growth. I think the lending part has been pretty simple. We can go with, either community banks that Derek may have a relationship with, or we have a relationship with. We can break it up into stages where we have a loan for just the horizontal, and then a takeout loan for just the vertical after that. There's various options, on how we kind of approach each deal. And I think a lot of it hinges on, what does the equity stack look like? So do we have to bring in preferred equity, meaning we have to pay a little bit more? And how does that affect the investor? And then how much are we bringing in as our, what we call retail investors, which is, our $50,000 to $250,000 investor. There's a lot of pieces to put together on the financing. But over the last couple of months, I would say I'm encouraged. There's certainly a lot of people that were affected by multifamily, in the sense that they've got now rate caps that have expired or are expiring, and there may be them having to pay another $600,000 that they didn't think they'd have to pay, right? To $1 million, $1.5 million, depending on the rate cap. So there's a little more predictability in the kind of financing that we're putting together.
Okay, cool. Let's talk a little bit about working with the city and the actual phases of development. What are the different phases that people have to go through when they're putting together a project of this magnitude? And how do you work with the city about this? Go ahead.
I know Chris has a few stories about how he's able to get us approved for Broussard and Foley. We had the experience, we had a pastor across the street who thought that we were doing Section 8, and then we talked to him, and now he's our biggest supporter, right? So things like that, Chris, I think will be helpful for people to understand.
Yeah, so during the entitlement process, we try to get as long of a leash as we can on our contract or our option on the property. We're asking for as much as 270 days or more now with extension periods. So we try to get a full year is what we target. Some of the hurdles, it's always something you don't expect. We had one project go through the entitlement period during an election season. And so we heard one thing at the beginning of the election season, and we go through, we have radio silence from those seeking office, and after the elections, then they come back to us with differing opinions than they gave to us in the beginning, which then affects our contract or our extension periods. That happened on our project in Broussard, where everything was pretty straightforward from the get-go. We went in on that one. There's a lot of facets here on this project. We went in as a single property. So there's different ways to do build to rent. You can go as individually platted lots or one giant property, just like multifamily. The city didn't like that particular aspect, so we agreed to individually plat the lots. That was going to bring up a lot of variances. And so we worked with the city and kind of whittled it down to something that worked for everybody. Time passes. We're going through our due diligence, our on-site testing, wetland surveys, topography surveys, boundary surveys, all that. And we get closer, we pass the election, and we get closer to our meeting time. The city reaches back out, and they've got differing opinions now on, they think we're Section 8. They have issues with, they think we're going to sell off these individual rent houses and no one's going to manage the property. And so we have to go in and then mitigate, those, opinions and risks to ensure the project moves forward. In that particular project, we had to meet with council members on site. We brought one council member to our other project, the Crest, let them walk in some of our model units and walk around the development and really kind of literally get into the dirt on what we're doing. And that went a long way. It slowed the project down, A, but B, it ultimately got there, and we ended up in a good place with the city. As you're moving through those processes, you're also doing some, light engineering work at the same time, and so you're spending money. the longer you're spending money and the longer before you close the project and get through engineering and getting to a point of revenue, you're having more at-risk money sitting out there. So those are sort of the risks as you're going through that process.
Derek, tell us a little bit about building a house. Is it the same phases of development when you're just building a one-off house as it is when you're doing a build-to-rent subdivision development?
No, I mean, in theory, you're doing all the same things and using the same subs, but when you're doing so many in the sequence, it's a completely different process for our subcontractors. They pretty much keep a crew dedicated to that project from start to finish. They might have guys out there for a year, depending on the number of units. So it gets simpler because it's the same thing. Even if we change up, our Broussard project has a unit mix. The Crest is all identical unit mix, but it's still the basic same setup and finishes. And once they do a couple, they get more and more efficient. We're able to cut out as much fat as we can on the process and on their timings, because they just move from one house to the next. There's not a lot of moving around, going to others. Whenever we're doing spec homes or custom homes, each one's a little bit different. Even if you do 5 or 10 of them, they don't remember that. They go off and do someone else's house. They come back, even though it's like, well, I've done this house 10 times. You should know. It's like, no, because they built 20 or 30 since they came and did that one. Whereas these, it's the same thing every day for these guys. And it just allows for a lot of efficiency. In addition to the same thing with materials, we have leftovers from one house. We could just scoot it down the line and kind of refine those orders, so you have even less waste just in that process, because all the houses are on the same street.
I think we're probably going to get to a point where we can have people ask some questions, but I do think that it's important for kind of people to think of this. Derek says terminology. There's blind spots, right, in the way that this is presented to people, right? We kind of have to always reevaluate how we're educating people, because it's got to be kind of simplified. And I think that when people think about what Derek does, they're like, I can't even lift a hammer, really do anything around my house. So he's actually building from scratch on this foundation that's already been laid, houses after house after house. And then you're also considering all the kind of God factors, which is whether you've got economic challenges with banking, with rates, whatever that is. The other thing is, I think people would be interested to hear a little bit, and Chris, I think this is for you maybe before we open up to questions, is what have we discovered about some of the kind of modular housing now, where we can maybe be a little bit more predictable in the timing that we build?
We call it offsite construction.
Yeah. I mean, I think
go.
some people might be curious to hear about it. Yeah, there you go. Offsite construction.
Modular has been around for quite a while. It's developed its own negative connotation over time, but we really don't see that that's the case nowadays. It's come a long way. It is exactly that term. It is offsite construction. It is an actual house, built to code. It's just not under the sun and subject to weather, manual labor inefficiencies. It's in a factory. It's very controlled. There's zero waste. They're very highly selective on the materials they use and grade. If they get a package of timber for framing and, they'll kick out the studs that are full of holes or warped or anything like that. They use only the best and they return the other wood. So what we've done is we've looked into using modular, and we've planned our developments to minimize the shipping on these modular units as well. So we're currently doing a pretty deep dive into costing on these as well. And what we've looked into is we can at least double the starts that we do per month by incorporating stick built and modular. And I think we can easily outpace ourselves on absorption, which that's the balance we try to strike. And we're working currently on how to structure the financing on the modular as well, since you have to put a deposit on a unit while you're still doing horizontal construction. That's some of the things we're still working out on the modular side, but it's something we're heavily investing time into as we move outside of our little 4-hour bubble. And we start to go into, markets, say in South Carolina or Florida, in, maybe the 8-hour bubble on incorporating modular builds, maybe entirely. So that's what we're looking at right now. And we're just discussing a lot of options with factories on, how they could maybe be more creative in how they finance or participate in the project.
Yeah, as Derek was alluding to, we're always looking for the creation of better and stronger efficiencies, and looking at offsite construction or other futuristic type of ways to build, like even 3D printing is always on our radar and something that we're keeping in the back of our mind. For now, we're doing primarily we're doing all stick build, but we're keeping our options open to keep our eyes on what makes most sense for all investors. And, I've talked to a lot of people about capital raising and people that are in development, people that are in different sub niches of multifamily, and ask them, what's the difference between raising for one asset class or the other? Is it different raising for a hotel than it is for a multifamily? And at the end of the day, what a lot of people are always constantly coming back and telling me on this show is that it really depends on your track record, your confidence, and what the investor goals are. So now that we have covered all of these different topics, I do want to kind of real quick before we open up for questions, and people feel free to type some questions in the chat. But Andy, what does it look like when somebody wants to potentially co-GP or partner up with us? Of course, we currently have 475 houses under construction in different phases of development amongst our 3 different development projects. But if we want to get to our goal of 10,000 units in the next 7 years, we're going to need some help. So when somebody wants to come and help us on the equity side and participation in a variety of other ways to stay legally compliant within the SEC guidelines, what does a partnership look like with Legacy and Hammerhead?
Yeah, no, it's a great question. We've worked really hard over those last 2 years to make sure that we've got opportunities for our JV partners and we kind of created a toolkit. We've got all of kind of the frequently asked questions. We've been hopping on webinars. We really do, in order to scale, really welcome having some good partners, just not on the capital raising side, as you know, per SEC, that's on the kind of skill set side, right? So we want people that can bring in capital, but they can also add some tools to our team, right? That's why I always try to stress to people that are either new to capital raising or coming from another career, they've got all of these skills that they've acquired in whatever their previous life was that can translate to helping us grow and scale. And so I always try to tell people, I've never raised capital before. Well, have you ever sold before? Have you ever underwritten something? Have you ever looked at a P&L? Have you ever been good at execution and getting things done, right? All of these are really valuable to the team that we're creating in order to build and get to the next level. So I would reach out to Ruben. He's kind of our lead on that. Certainly, I would be happy to talk to people about what we're doing. I'm really proud of the team we put together. And it's really important for us to keep these guys moving forward, right? So at each stage, there's capital that's required. As Chris mentioned, we spend money to get to this stage, spend money to get to the next stage. And so as we've got so many of these units that are starting to make sense for us, we're going to need some partnerships that are meaningful.